Welcome back. So today we're going over the cash flow statement, and my hope is that you understand it in a different way after watching this video, because to me, out of the income statement, balance sheet, and cash flow statement, the cash flow statement is the most important to understand. I think it tells the best story about the company, but you got to know, what you're looking at. The balance sheet's number 2 in my opinion, and arguably number 1 but that's a different discussion. So what I have here is a little diagram I made, the kind of trinity of the cash flow statement, right? There's 3 categories. There's operating cash flow, investing cash flow, financing cash flow, and then the business I'm going to represent by this black dot in the middle. So the standard company, and it's not every company, but these are, dare I say, the good companies, look like this. So you have operating cash flow that is positive, meaning towards the business. They're using that money to invest in the business. So red here just means leaving the business. It doesn't mean good or bad. It just means leaving the business versus going to the company coffers, if you will. Okay. So like I said, positive operating cash flow, then they reinvest that money in the form of CapEx or other things, and then leftover money gets sent to financing cash flow, usually in the form of, let's say, dividends, stock buybacks, or debt pay down. I mean, those are the big ones. All right. However, so this is the standard company, right? But there are other scenarios, and I want to touch on those briefly. Okay. So the first one is negative operating cash flow. All right. If you see this on a long-term basis, and I didn't say it already, but these are all on a long-term. You can't look at these on a quarterly basis because cash flow bounces around like this. You kind of have to look at it, over the course of several quarters or years, But anyway, negative operating cash flow, just stay away. That's terrible. There are some exceptions. I think Liberty that we talked about might be an exception, but maybe not. The exceptions are few. This is probably a general good rule of thumb if you have negative consistent operating cash flow to stay away, right? The next scenario is going to be positive operating cash flow. Same thing, they're reinvesting in the business. However, what's going on here, the financing cash flow is positive. So this is usually the case whenever the operating cash flow is positive, but not positive enough to keep up with what's needed to run the business in the form of CapEx or other stuff. So the company's having to tap into financial resources, meaning they're having to go into further debt or dilute stocks. So yeah, that's probably not a good sign if you ever see a consistent positive financing cash flow. And then the last example would be something like this. So let's say you're breaking even on operating cash flow. Investing cash flow is positive, which is strange, right? That means that they're usually selling assets. And we do see this. This is probably a better example of Liberty because they're selling the assets and then taking that money and pushing it to the financing cash flow. And I think that this can work. It's kind of a liquidation strategy, but it's one of those special situations, right? The easiest one is the first example I went through. But anyway, I think it's really important to kind of understand what type of company you're investing in and to make sure it looks like that first scenario, right? So let's talk about these 3 areas, okay? And I'm going to start with the financing cash flow, the bottom right here. All right, so what are the things that make it green? What are the things that make it red, right? Okay, so dividends, first one. You're paying out a dividend. It's going to be money leaving the business going towards financing cash flow. It's going to be negative, right? Debt can be positive or negative, right? If you're issuing new debt, if you're going into further debt, that's going to be positive. That's going to be money coming to you, cash coming to you. And then if you're paying down debt, paying down the principal, it's going to be cash leaving the business, right? Share count, likewise, can be both. Repurchases would be money leaving the company going towards financing cash flow, and then dilution would be them getting cash at the cost of diluting shareholders, all right? So in general, look at what makes it green, new debt and dilution. Like that's why you don't want to see a green arrow for financing cash flow. Dividends, thank goodness, can only be one way. Can you imagine like a reverse dividend? That'd be wild. All right, so that's the financing cash flow. Next up, we're going to talk about the investing cash flow. So this one, the first thing I put was acquisitions. If they're buying other companies, that's usually going to be in the investing cash flow. Sale of assets is kind of the reverse of that, where they're generating cash from selling their stuff, right? And then CapEx is always a cash outflow, right? Now, I'm going to talk about 2 different forms of CapEx, though, because I think that's important to understand. There's maintenance CapEx and growth CapEx. So some people call these different things. You'll hear maintenance CapEx sometimes called routine CapEx or what's another word? Mandatory CapEx. To me, that's different than growth CapEx. Maintenance CapEx is really an expense to run the business, and growth CapEx is more of a investment, right? A true investment. Like they don't have to do this, but they're going to do it because they're expecting to grow earnings. Whereas maintenance CapEx is like, hey, the stuff's broken, or we need this X amount of CapEx to keep up with the real depreciation of the assets, that sort of thing. All right, and then securities usually fall under investing cash flow. If they're purchasing stuff, that's going to be a red arrow, and if they're selling their securities, then it's going to be green. Not their own stuff, not their own stock, that's in the financing cash flow, but I'm talking about buying corporate bonds or stuff like that. All right, lastly, the operating cash flow. So the operating cash flow starts with the net income, which is their income on paper from a tax perspective, and then it adds in the non-cash expenses. So if something was an expense in the income statement, but it didn't actually cost you cash, it's going to get added back here. All right, so first example, and usually the big one is depreciation. So depreciation gets discounted whenever for tax purposes in the income statement, but it's not a real cash expense, so it gets added back. So having high depreciation will actually, help your cash flow, right? Amortization, same as depreciation. Stock-based compensation. All right, this one is unfortunate, but it's true. So stock-based compensation technically is not a cash expense because the company's not putting up cash, but it really should count whenever you're doing your free cash flow calculation, and we're going to talk about that later, but just need to keep in mind which way it makes the arrow go, right? All right, and then inventory. So inventory increase, inventory decrease. So if your inventory on the floor is, let's say that you can't sell anything, but you're buying all these raw materials, so it keeps on piling up. Well, you've spent cash and you have inventory on the floor. From a balance sheet perspective, your balance sheet stayed the same. As far as current assets go, cash went down, inventory went up, but it's still the same net value. But that would be very deceptive to just look at, let's say, current assets, because your cash position really changed. And likewise, you could have a big sale or something and sell a bunch of your inventory and you generate a lot of cash, but inventory goes down. So from a balance sheet perspective, again, it doesn't look like it changed. So that's important to know. And then other working capital changes can affect it. Things like changes to accounts payable, accounts receivable. There's other stuff. But in general, those categories, I think on a long time scale, should cancel each other out. It might jump around a lot on a short time scale, but overall they should be about the same, right? So that's the three branches of the cash flow trinity. I want to talk about free cash flow though, because I think understanding the true free cash flow or owner earnings of a company is the most important thing to get a good valuation. All right, and the standard equation is this: free cash flow is operating cash flow minus capex, and capex is usually the majority of your investing cash flow. So I'll mark it in this little orange pie. So that's most of your capex. However, like I said before, not all of your capex is a true expense. Only some of it is. Other bits of your capex are growth or investment purposes. So I'll break it down into two sections: maintenance capex and growth capex. And I separate them because I'm trying to get to that equation of, hey, look, if I was the owner, what would be my pool of capital available to allocate? All right. So that's why I really like to look at maintenance versus growth. Now, big caveat here, and that is that maintenance capex, I think, is usually underreported. A lot of times they'll say something is a growth project, but in reality, if they don't do it, the business would suffer or stuff would, be at the end of life. So you need to be a little skeptical about what management says is maintenance capex versus growth capex. I think just as long as you're conservative, you should be all right. All right, the other problem with the free cash flow equation, in my opinion, is taking the full operating cash flow, because there's this little sliver usually that is stock-based compensation. And I said little sliver. If it's a big sliver, you have other problems on your hand, right? So stock-based compensation should, in my opinion, be subtracted whenever you're looking at kind of owner earnings. Now, what that gives me is my new equation, which is operating cash flow minus stock-based compensation minus just the maintenance capex. And I think if you take this and you get a really good idea for it, that would be the best thing to use for like DCFs or getting a free cash flow yield, that sort of thing. All right, so that's my take on free cash flow. I want to talk about capital allocation because I think it's a really crucial part of judging management and investing, And it really comes from the cash flow statement, how you can judge capital allocation, or at least see what they're allocating capital on, right? All right, so capital allocation would be all of those cash outflows that we talked about. So from the investing side, it's going to be acquisitions, growth CapEx, buying stocks, buying bonds. From the financing cash flow side, it's going to be dividends, paying debt, repurchases. How do you compare all these options? How do you compare apples to apples? That's what's kind of the problem in my head, and why I wanted to make this video is try to figure that out. And I think the right answer is to get them all to one number, and that number is yield. So I have a table here with everything, and then I'm going to run through a specific example that I've made up. But the goal is to get everything to one number and then compare those numbers. All right, so dividends, in my opinion, that the value of the dividend is, let's say, the 30-year interest rate, or let's say a typical discount rate. It's going to be somewhere in like the 5 to 8%, let's say 6 to 8% rate. Right now, I think it's 7.5%. And the reason I say that is that, let's say that, Joe owns some shares of your company. If you pay him a dividend, what is that money worth? Well, it makes sense that, in general, he probably has some debt, or that's at the 30-year interest rate, and so he would use it to pay that off, or that would be his discount rate whenever looking at other stocks. So that just kind of makes sense to me that the number for dividends would be about the 30-year interest rate. Debt pay down is easy. Debt pay down is the yield that you're gaining is equal to the interest rate. Now, I will say that debt pay down has this added bonus, though, of reducing the risk of bankruptcy. I mean, it's sometimes, even if the yield's lower, you're still going to want to pay down debt. So then repurchases. Repurchases are going to be 1 over the PE. I said PE. I mean, probably you want to use cash PE, not income PE. But, we're just trying to keep it short here. Repurchases and dividends. I don't have an asterisk next to repurchases because technically you could reverse them by doing dilution, but you really can't reverse a dividend, and you probably should never be reversing repurchases, because so those are riskier options because the money's gone, especially dividends. Once a company decides to pay a dividend, poof, it's in the shareholder's hand. It's not coming back to them. Everything else pretty much is reversible. If they pay off debt, they can go back into debt. If they repurchase shares, they could dilute it. If they buy an asset, they could sell an asset, that sort of thing. But dividends is, gone. So it's a higher risk option, in my opinion. All right, and then after repurchases, acquisitions. A lot of companies do this. They'll do the post-integration PE, which I agree with. I mean, if you think that you can cut costs because you're going to be consolidating and all that, then you really should judge it on a post-integration PE. Growth CapEx is going to be the return on investment. So that's going to be what's the yearly savings divided by the total investment. Bonds is going to be the adjusted interest rate. So, usually if you're buying a bond at 100% of fair value, it's easy. It's just going to be the interest rate. But usually you're paying a little bit of a discount on that. So we'll go over that in the example. And then stocks is the same as repurchases, like 1 over PE. All right, so let's do the example because I think that is interesting. Let me get my calculator back up here. All right, dividends, 30-year interest. Right now it's 7.5%, so I'm going to say 7.5% for dividends. All right, debt. So in this scenario, the company could pay off 6.9% interest rate debt due in 3 years. The due in 3 years has no bearing here from a math standpoint. It might influence the decision psychologically, but anyway, the yield is 6.9%. All right, repurchases. Their stock is trading at an 8 PE on expected future earnings. So that would literally just be 1 over 8 would be 0.125, which would be 12.5%. All right, they can acquire another company. In this scenario, they would pay 15 times earnings for that acquisition, but expect to increase earnings 33%, right after buying it due to consolidation and all that. So that's easy. It's just 1 divided by 15 times 1.333, and you get 8.8, or I'll just say 8.9%. All right. Growth CapEx. So some engineer comes pitching a project that's going to be $17 million a year savings on $150 million of initial investment. So 17 divided by 150 is 11.3. Next, they can buy bonds on the market that are paying an 8% interest, but they're on sale for 90%, 90 cents on the dollar, right? So that one's also easy. That's just 8 divided by 90, and that is 8.9% again, or 8.8%. Oops. Anyway, stocks that can invest in other companies' stocks that are roughly at a 12 PE, that's just going to be 1 divided by 12, so 8.3%, right? All right, so which one of these is the best? And of course, it's the repurchases. And I actually think that this is commonly the scenario with a lot of companies, but for some reason, they shy away from repurchases. It is usually, I think if they really went through this exercise, they would find that it's by far the best way to return value to shareholders, especially if their PE is under 10 usually. However, they don't do it because I think it's one of those, it's semi-non-reversible. I mean, once you buy back shares, you're really not going to be diluting anytime soon, right? And these other things can sometimes just look really appetizing, like the growth project that a lot of times gets overestimated. Acquisitions get overestimated with high projections. But that's it. I hope you learned something from the video. I enjoyed putting it together. Like, comment, subscribe. I'll see you next time.